We have a quick question here from Sergey asking what exactly is a STIR futures contract? Now, thanks for the question. So a STIR futures contract is usually a short-term interest rate futures contract with short-term meaning it will only include usually maturities of less than a year. Now, think of these contracts as just another way for investors to trade short-term interest rate expectations or to try and hedge against any unexpected fluctuations in money market prices. So something that's different from these contracts compared to something like bond yields, for example, are that they are not yield quoted, they're normally price quoted. So prices might look different compared to the yields of a particular interest rate. So that's important to know because even though a falling yield usually refers to falling interest rates, the STIRs are basically yield subtracted from a base of 100. So let's do a quick example of that. So let's take out the calculator. So let's say the 3-month T-bill has a yield of 0.5%. The equivalent STIR futures contract will have a value of 100 minus that 0.5%. So your contract price for that particular STIR would be 99.5. So the price of these STIRs move alongside bond prices, meaning they are inversely correlated to your yields as well. So if you think interest rates are going to go lower, let's say between now and the next 6 months, 6 months from now, you can buy a STIR futures contract of which there's a couple available in the market. And if interest rates indeed move lower, your futures contract would be worth more, meaning that you made a profit. So let's do a quick example. Imagine that you bought a STIR. Let's say you are buying a Eurodollar STIR futures contract. Now keep in mind that the term Eurodollar in terms of a STIR or a futures contract is not the same as the Eurodollar currency pair. In the sense of a STIR, a Eurodollar just refers to dollar-based accounts or dollar-denominated accounts that's held in foreign banks outside the US. So let's say you bought a Eurodollar STIR futures contract that's based on the 3-month LIBOR or London Interbank Offer Rate. Now that's basically just the rate at which global banks lend to each other. Now imagine that you bought the contract at, let's say, 99.50, like we just saw here. So you bought that Eurodollar futures STIR contract at 99.50, and it's based on the 3-month LIBOR. And imagine that the 3-month LIBOR at the time was 0.5%. So that's why you paid 99.5. Now imagine that you bought it because you thought that interest rates were going to go lower. Now when the contract actually expires, imagine that the 3-month LIBOR is now at, let's say, 0.25%. That means that your Eurodollar futures STIR contract has gone from 99.50 all the way to 99.75, which means that it's worth more. And when it gets paid out, you obviously made a profit from it. So these STIR contracts are just short-term interest rate contracts that tries to hedge against these, unwanted or unexpected fluctuations in short-term interest rates. And that is basically what's referred to a STIR futures contract. So I hope that helps with the question, Sergey. Any other questions, don't hesitate to let us know.